Good afternoon and welcome. My name is Michelle Deharsh, Sales Manager in the Disability Income Department at Financial Brokerage. I appreciate you joining us this afternoon. Today's topic, we are going to ask, why is protecting your income important, and does disability income protection really matter? Basically we're going to highlight the things that come to mind and the things that clients really need to consider when they're either saying, no, I don't need disability. They really need to consider what it all entails and what it all covers and how it can really affect lifestyles going forward if they don't have it. So how long, if you asked your client this question, how long could you pay your bills without your income? What their answer would be. Many Americans are poorly positioned financially should illness or injury interrupt their ability to work and earn an income, but yet very few have disability income coverage outside of work. Some of that coverage also has long elimination periods and short benefit periods, and with that in mind, thinking of elimination period, how long could they go without an income? Could they even make it as long as the elimination period is on their maybe their group long-term disability plan or their individual plan? Most people nowadays some live paycheck to paycheck. So you can imagine if they don't get a paycheck and having to satisfy whether it's 60 days, 90 days, 120 days of an elimination period without any income, how hard it would be. So it is really interesting if you look at it, how long this chart on the screen, how long wage earners estimate they can continue to pay bills if they lost their income. 27% say 3 months to 1 year that they could continue to pay their bills. 23%, almost 25%, almost a quarter of them say only 1 to 3 months. That's 30 to 90 days that they could pay their bills. So what would happen after that point? A larger number is 35%. And 15% say less than 1 month. They couldn't pay their bills less than a month. So where do you think your clients would fit on this chart? Are they in the 3 months to a year? Are they less than a month? Regardless of where they are, you should really have the conversation about disability income protection with them. Because if it's even a concern at all, going 1 month or a year, that's all you could fund. You need some type of protection in place to help you through that time. And on that, during a disability, unfortunately, these regular expenses listed below, they continue. They don't stop because you stop working. The client stops working. They just continue to go. Things like food, housing, cars, utilities, your electric bill, insurance copays, treatment for travel expenses, in-home care, home modifications. Let's say someone needs to modify their home, to maybe get in and out of a shower easier or a wheelchair ramp, something of that nature. The disability has set them to where they need to do home modifications. How they're going to have to pay for that. How are they going to continue not only that, but these expenses listed if they have no income? One thing to think about is if the client took an extended leave from their work and they have to pay COBRA premiums. We all know that those are significantly higher premiums. How are they going to do that? Plus, going even further on that point, there could be additional disability-related expenses, things like child care. A lot of carriers, there are some carriers that we have, they actually insure a stay-at-home parent. So even though their primary purpose there is to provide care to their children, whether it's 1, 2, 3, 4 kids, that's a very important role. And what would happen if that stay-at-home parent, that caregiver, were to have a disability and he or she couldn't care for those children? Daycare expenses are very expensive. So how would that family compensate for those, let's say, 3 kids that she's been taking care of without her being able to do it? Going on those points, and let's say if a disability occurs and you have no plan, where do you think the money would come from? Well, it would probably come from your savings for retirement, and the insurance premiums that you're paying for retirement, whether it's, protection in other insurance products, but your money, your savings, your CDs, the funds that you're putting away for later on, they would probably have to dip into that to help offset the income loss without having disability income protection. So we just really want you to have this conversation with your clients. A lot of us take it for granted, these things that we buy on a daily basis, food, and maybe we electronically bill pay our utilities, and our car payments just directly come out of our bank accounts, and we know they're there and they're coming out, but we also know that we have an income coming in. What would happen? What would be that amount that would total that if they were to have a disability for 90 days or a year or 2 years? Would they be able to do this? How would they pay for this? And this is a great question to ask your client. Make them really think about this. So what would you do tomorrow if you could no longer work and earn an income? What would be their answer? Really make them think about it. And when they're done telling you or thinking, do you have a plan B that provides for you and your family? So with that, let's just say you have a client, plan A. He makes $100,000 annually. Him and his family, he brings in $100,000 annually, doesn't have a disability income plan in place, and he becomes sick, and he's too sick to work. And that family's income goes from $100,000 to zero because he wouldn't get anything. He is not able to go to work. He has no group long-term disability plan in place. He doesn't have an individual plan in place. So that family or that individual just went from a lifestyle of $100,000 in salary to zero. And when you have a plan like this where you don't have any protection in place, I would think that one would want to get better quick. And by doing so, you might not be healing correctly. You might be going back to work too soon, which may result in being out of work again. There's just not a lot of good that would come from not having a disability income protection plan in place. So plan B, same person. Instead of $100,000, he decides he's going to make $98,600 because $1,400 of his salary he is now put towards a disability income protection plan. So he gets sick again. He is unable to return to work. His disability benefits kick in because he has one. And yes, his income is reduced to $60,000, 2/3 of his income, but there's something. And that's what we're trying to reiterate today, that you don't have to, bag the elephant or come up with these big quotes that cover almost all of their income. Yes, if they can afford it, absolutely. If that's what the client's goals are and that's what their needs are and that is what they want. But at the same time, I can guarantee you Plan A client would have been really happy with at least $60,000 and only having to pay maybe $1,400 or $2,000 of his income towards that income protection plan. The $60,000, again, yes, it is a reduced salary, but it can pay for things to help them through that time, whether it's their mortgage or just keeping the food and the groceries on the table, their electricity on. It is something. So asking your clients after you show them this, what plan would you rather have? At times you consider, well, I don't know if I can afford, and your client can afford another $80 a month, or maybe even it's $50 a month, so $600 a year. Then you ask them, so what are your priorities? When you've approached them with a quote and they say, well, no, that's too much. I don't really want to spend $40, $60, $80 a month on disability income protection. I don't need that. Then you ask them, well, which of life's wants are most important to you? Do you enjoy your daily cup of Starbucks coffee, your gourmet coffee? Do you have date night with your spouse or significant other, each week or each month? And cable service, high-speed internet, and smartphones. We all know smartphones are very expensive. We also know that you're on a monthly payment plan. So the wants that are listed above, would they be would they be able to have those without their income? The answer is probably no. And what would happen if they were too sick to work? Well, it would all go away. So telling your clients to look at their budget. The average individual disability income insurance policy can cost about only 1 to 3% of your income. So taking 1 to 3% of your income and allocating that to an individual disability income plan policy doesn't seem like much, considering client A, plan A, where he was making $100,000 and he lost 100% of his income. So having them look at it from a perspective of 1 to 3% to protect maybe a reduced amount of their income while they're going through that hard time is an easier concept to actualize than to say, oh, and your premium's $125. Really getting them to think. Make them think about their own life choices, what their priorities are, what their expenses are. And if you really truly think about it, think how much is a date night? You know, if you do $50 to $70 every week, you're upwards $200, $280 a month. And all of a sudden that $70 premium to protect your income doesn't seem like that much. So using analogies in that with your client are good sales ideas. But again, just ask them these questions, having them understand, bring it up to them, make them realize what their lifestyle costs and how quickly that lifestyle could go away. So taking a look at this picture, I think we can all see that not all risks are this easy to spot. And approximately 95% of disabilities they're actually caused by illnesses and sicknesses rather than accidents. When you ask your clients, have you ever thought about disability income protection? They probably immediately think, I'm not going to get hurt. Oh, if I get hurt, I won't be very long. They all think of it as an injury. Well, they need to understand that it's more than getting hurt. And 95% of all disabilities are caused by illnesses and sicknesses. And so stressing that it's not only climbing on a roof like this picture shows and falling and getting hurt, or slipping on the ice, or playing some sports and having a knee injury. Yes, those are all accidents, and yes, your disability income will pay, but how are they going to answer when you tell them that 95% of all disability claims are caused by illnesses, prolonged sickness? That's a pretty big percentage. And yeah, they probably won't get hurt, but their chances are a lot better of getting sick or having an illness. So stressing those two things, that it's not always about getting hurt. It can be a combination of all three things. This is kind of a bold point here, but 1 in 4 of today's 20-year-olds will become disabled before reaching age 67. This is from the February 2013 fact sheet edition from the Social Security Administration. 1/4 of 20-year-olds will become disabled before reaching 67. That's a lot. According to economists who have analyzed Labor Department data, 6.6 million people exited the workforce from 2010 and 2013. And of that 6.6 million, about 28% of those left due to a disability, which was up significantly from 2007 to 2010. 28% of 6.6 million, that's 1.85 million people, left from 2010 to 2013 because of a disability. I would really like to follow up that statistic and want to know how many had a disability income plan in place. That would be really interesting to know. But looking at that top point, 1 in 4 of today's 20-year-olds, the younger, and you all know this, the younger someone is, it's usually easier, generally easier, they're more insurable. They don't have the medical history. They don't have the conditions that